China's substantial silver purchases. The impact on the global market. Could the Yuan be backed? Right now, while most investors sleep, China is executing the largest silver accumulation in modern history. Domestic prices have decoupled from international markets. A premium that shouldn't exist is widening. State entities are moving tonnage that exceeds official industrial forecasts by margins that raise one question nobody in mainstream finance will ask out loud. What if this isn't about solar panels, or 5G infrastructure, or electronics? What if Beijing is preparing the architecture for something the dollar system cannot survive? The data is already visible, but the interpretation changes everything. Welcome to metal, or we're macro. If experience has taught you that markets move long before headlines explain why, then you understand the value of what we examine here. This channel exists for those who prefer signal over noise. If that resonates with you, consider subscribing. Not because algorithms demand it, but because strategic insight compounds when you stay consistently informed. And before we proceed, tell us in the comments, from which corner of the world are you watching this? Because monetary shifts don't respect borders, and neither does this community. In the first weeks of 2025, a quiet anomaly emerged in global commodity markets. Silver prices in China began trading at a premium to international benchmarks. Not a small premium, not a temporary blip caused by logistics or seasonal demand. A sustained, widening gap that defied the normal mechanics of arbitrage. For decades, the London Bullion Market Association and the COMEX in New York had set the tone for global silver pricing. When physical metal moved across borders, prices converged. Traders exploited tiny differences. Markets balanced themselves, but something changed. By late January, the Shanghai Gold Exchange was reporting silver premiums of 3 to 5% above London spot prices. In some regional Chinese markets, the gap stretched even wider. Dealers were paying more, significantly more, for physical delivery inside China than they would pay anywhere else in the world. This was not normal. Analysts who track precious metals flows began asking questions. Import data painted a striking picture. In 2023, China imported approximately 8,000 metric tons of silver. In 2024, that figure jumped past 10,000 tons. Preliminary data for early 2025 suggested the pace was accelerating further. The Shanghai Metals Market published monthly figures that confirmed what traders suspected. Physical silver was flowing into China at volumes that exceeded previous records. Refineries were running at capacity, vaults were filling, and the premium persisted. Industry consultants offered the standard explanation. China's industrial demand was surging. Solar panel production had expanded dramatically. Electric vehicle manufacturing required silver for components. Electronics factories needed steady supply. The narrative made sense on the surface. But seasoned commodity analysts recognized something else in the data. Industrial demand grows predictably. It follows production cycles. It responds to price signals. And when silver becomes expensive, manufacturers adjust specifications. They substitute materials. They optimize usage. Yet Chinese buyers were not behaving like cost-sensitive industrial consumers. They were buying regardless of price. They were buying in volumes that suggested urgency rather than routine procurement. They were buying as if the metal itself, not the products made from it, was the objective. State-owned enterprises dominated the buying. These were not speculative traders chasing short-term profits. These were entities with access to central planning directives, entities that move when policy priorities shift. Financial intelligence firms that monitor sovereign wealth and state institutional activity began flagging the pattern. The accumulation was systematic, it was deliberate, and it was large enough to move global supply chains. Meanwhile, above-ground silver inventories in London and New York were declining. The COMEX reported consistent withdrawals from registered vaults. Bullion dealers in Europe noted tightening physical availability. Premiums for immediate delivery began creeping higher in Western markets as well, though nothing compared to the premiums inside China. This created a puzzle. If silver was flowing east and premiums in China were higher, why weren't Western dealers shipping every available ounce to capture that arbitrage? The answer lay in access and infrastructure. Chinese buyers were not shopping on open exchanges. They were negotiating directly with miners. They were securing long-term supply agreements. They were bypassing traditional distribution channels entirely. Several major silver mining companies confirmed in quarterly reports that Asian demand, specifically Chinese demand, had become the dominant factor in their sales forecasts. One Canadian miner noted that nearly 40% of its annual production was now contracted to Chinese buyers under terms that prioritized delivery certainty over price flexibility. This was not typical industrial procurement. Industrial buyers negotiate for the best price. They play suppliers against each other. They defer purchases when inventories are sufficient. Strategic buyers do the opposite. They lock in supply. They accept premium pricing. They prioritize volume and certainty over cost optimization. The pattern resembled something financial historians recognized from previous cycles. Between 2009 and 2015, China accumulated gold quietly and systematically. Official reserves grew slowly in public disclosures, but import data told a different story. Tonnage flowed into Shanghai and Hong Kong at rates that far exceeded reported additions to central bank reserves. Years later, Beijing announced a significant upward revision to its gold holdings. The market had underestimated the scale of accumulation. Now observers were watching the same dynamic unfold with silver. The question was no longer whether China was buying aggressively. The question was why, and whether the market understood what would happen when the reason became clear. Numbers tell stories when someone knows how to read them, and the numbers coming out of China's silver market were telling two different stories at once. On the surface, everything appeared logical. China had become the world's manufacturing powerhouse. Its factories consumed raw materials at scales that previous generations could barely imagine. Silver fit neatly into that narrative. Solar panel production alone justified massive silver consumption. Each photovoltaic panel required approximately 20 grams of silver paste for conductivity. China manufactured over 70% of the world's solar panels. The math seemed straightforward. Electric vehicles needed silver for electrical contacts, membrane switches, and battery management systems. China dominated global EV production. Another box checked. 5G infrastructure rollout required silver-coated components in base stations and network equipment. China had installed more 5G towers than the rest of the world combined. The industrial story held together, but then the cracks appeared. Researchers who studied commodity flows noticed something unusual. They compared China's industrial output growth rates against its silver import acceleration. The lines didn't match. Solar panel production had increased by approximately 18% year over year. Silver imports had jumped by nearly 30%. The gap was significant. Moreover, engineers in the solar industry had been working for years to reduce silver content per panel. New metallization techniques and alternative paste formulations had cut silver usage by almost 20% compared to panels manufactured 5 years earlier. If production grew by 18% but silver content per unit dropped by 20%, total silver consumption should have declined slightly, not surged. Yet the imports kept climbing. Analysts began examining other sectors. Electronics manufacturing showed similar patterns. Production volumes were up, but not enough to explain the metal consumption rates. Companies were actually becoming more efficient with silver usage, not less. The EV sector presented another puzzle. While vehicle production had increased, the amount of silver per vehicle remained relatively constant. Some models even reduced silver content as manufacturers optimized designs for cost efficiency. None of this explained why China needed substantially more silver than its industrial growth trajectory suggested. Then, a different framework emerged. Economists who specialized in strategic resource management introduced a concept they called dual-use accumulation. The idea was simple but profound. Certain commodities serve two masters simultaneously: industry and state security. Oil was the classic example. Countries consumed oil for economic activity, but they also stockpiled it for strategic reserves. The stated reason was industrial. The real reason included geopolitical insurance. Grain followed similar logic. Nations imported food for consumption, but they also built reserves that far exceeded immediate needs. The official explanation focused on food security. The underlying motivation included leverage and autonomy. Silver could function the same way. China could legitimately claim industrial demand while simultaneously building a strategic reserve that served entirely different purposes. Historical precedents supported this interpretation. In the early 2000s, China began accumulating gold aggressively. Official explanations centered on jewelry demand and industrial applications. Central bank purchases were disclosed slowly and conservatively, but import data revealed a different scale. Between 2009 and 2016, Switzerland alone shipped over 2,000 tons of gold to China and Hong Kong. Other sources added thousands more tons. Yet official reserve figures barely moved. Where did the gold go? Years later, Beijing revised its official holdings upward. The market had systematically underestimated state accumulation because buyers assumed industrial demand explained everything. Now, similar dynamics were unfolding with silver. State-owned enterprises in China operate under guidance that Western analysts often misunderstood. These companies didn't function purely as profit-maximizing entities. They executed policy objectives that aligned with national strategic goals. When a state-owned metals trading company signed a long-term supply contract with a mining firm, the decision wasn't made in a boardroom focused solely on quarterly earnings. It was made in coordination with planners who thought in decades, not fiscal years. This created a fundamental attribution problem for market observers. Western analysts looked at Chinese silver imports and calculated industrial consumption rates. They built models based on factory output and component specifications. They assumed rational economic behavior within a market framework they understood. But they missed the possibility that procurement decisions were being made in rooms where industrial efficiency mattered less than strategic positioning. Academic papers from Chinese research institutions offered subtle clues. Scholars affiliated with state policy groups had published analyses exploring the role of precious metals in currency stability. These weren't fringe publications. They appeared in journals read by officials who shaped economic policy. One paper from a Beijing-based think tank examined historical monetary systems and the relationship between metal reserves and currency confidence. Another explored hybrid models where partial commodity backing could enhance international acceptance of a currency without requiring full convertibility. These weren't policy announcements, they were intellectual explorations, but they indicated that conversations about metals and monetary architecture were happening at levels that mattered. Meanwhile, the physical silver kept moving east. Shipping manifests confirmed it, vault reports documented it, refinery production schedules reflected it. China wasn't just buying silver, China was absorbing available global supply at a pace that would eventually force a reckoning in markets that had operated for decades on the assumption that physical metal availability would always match paper contract obligations, and that assumption was about to be tested. Every currency carries an invisible burden, the burden of trust. For decades, the United States dollar carried that burden effortlessly, not because of gold backing, that link severed in 1971, not because of superior economic fundamentals. Other nations often ran tighter fiscal ships. The dollar dominated because the world agreed it would. That agreement was fraying. In the spring of 2024, something unprecedented occurred. For the first time in modern history, central banks in emerging economies reduced their dollar reserve holdings for 3 consecutive quarters. The shift was measured in basis points, not dramatic plunges, but the direction mattered more than the magnitude. China watched this carefully. The Yuan faced a fundamental problem. Despite being the currency of the world's second largest economy, it represented less than 3% of global reserve holdings. International trade increasingly involved Chinese goods, Chinese infrastructure projects, Chinese investment, yet transactions still settled primarily in dollars or euros. Beijing had spent years trying to change this. Currency swap agreements with dozens of nations, the establishment of Yuan clearing banks in major financial centers, the inclusion of the Yuan in the International Monetary Fund's special drawing rights basket. Progress had been incremental at best. The obstacle wasn't technical. Modern financial systems could handle yuan transactions as easily as dollar transactions. The obstacle was confidence. Foreign holders wanted assurance that the currency would maintain value. They wanted to know what stood behind it when political winds shifted or economic pressures mounted. The dollar's answer had evolved over decades. It rested on military dominance, institutional depth, legal frameworks, and the sheer inertia of global finance. These factors created a network effect that was extraordinarily difficult to challenge. But history showed that network effects could break. The British pound sterling had once dominated global finance with similar seeming permanence. Yet within a generation, its reserve status collapsed. The transition happened not through formal declaration, but through accumulating decisions by market participants who quietly shifted their preferences. Chinese monetary strategists understood this pattern. They also understood something Western economists often overlooked. Every major currency transition in history occurred alongside shifts in commodity backing or commodity access. When the dollar displaced sterling, it coincided with American industrial dominance and control over crucial resources. When oil transactions shifted to dollar settlement in the 1970s, it reinforced dollar centrality precisely when gold convertibility ended. Commodities provided something that pure fiat promises could not, tangible anchor points that existed outside political declarations. Gold had played this role for millennia, but gold presented problems for a currency seeking to expand its international footprint. Gold supplies grew slowly. Gold served primarily as a store of value, not an industrial input. A gold-backed currency would constrain economic flexibility in ways that modern economies found unacceptable. Silver offered different characteristics. Annual silver production ran approximately 10 times higher than gold production by weight. Silver had genuine industrial applications that created sustained demand beyond monetary hoarding. Silver's lower price point per ounce made it accessible for broader economic transactions. Most importantly, silver accumulation could occur under the cover of industrial demand without triggering the alarm bells that massive gold purchases would inevitably sound. Chinese academics had explored these dynamics in papers that received little attention outside specialist circles. One analysis published by researchers at Renmin University examined historical bimetallic standards and their potential application in modern hybrid systems. The paper didn't advocate for a return to fixed convertibility. Instead, it explored what the authors called reserve ratio anchoring, a system where currency issuance maintained a floating relationship to commodity reserves without promising direct redemption. Under such a framework, A central bank could announce that its currency supply would maintain a specified ratio to its holdings of strategic commodities. Not fixed, not convertible, but visible and verifiable. This would create market confidence without creating the rigidity that doomed historical gold standards. Another paper from a Shanghai-based policy institute examined the BRICS nations' discussions about alternative settlement systems. The authors noted that proposals for a BRICS currency faced enormous coordination challenges, but they suggested that commodity-weighted clearing mechanisms might offer a transitional pathway. Imagine a settlement system where trade imbalances between member nations could be resolved not just through currency exchange, but through transfers of commodity allocation rights. Nations running trade surpluses could accumulate claims on silver, gold, rare earths, or other strategic materials held in shared reserves. This wasn't theoretical fantasy. Commodity-backed clearing systems had operated successfully in earlier eras. The European Payments Union after World War II used similar principles. What made the concept newly relevant was digital infrastructure that could track and settle such arrangements with efficiency impossible in previous generations. China's position in this potential architecture was unique. It was simultaneously the world's largest commodity consumer and an increasingly significant commodity producer. It controlled rare earth processing. It dominated solar panel production. It held substantial gold reserves, and now, apparently, substantial silver reserves. If a commodity-weighted settlement system emerged among nations seeking alternatives to dollar dominance, China would enter with meaningful backing already in place. But this raised technical questions that Western monetary experts immediately highlighted. How would commodity backing work in practice? Would it require full convertibility? How would price volatility be managed? What happened when commodity values diverged from currency values? These were legitimate concerns, but they assumed that commodity backing meant a return to 19th century gold standard mechanics. Modern approaches could be far more sophisticated. A central bank could publish real-time data on its commodity reserves. It could commit to maintaining currency supply within a specified ratio band relative to those reserves. It could allow the ratio to float within boundaries rather than fixing it rigidly. This would create market discipline without creating economic handcuffs. More importantly, it would create something that pure fiat currencies increasingly struggled to provide, a visible, verifiable constraint on monetary expansion that existed outside of political discretion. In an era when trust in central banks was eroding globally, that constraint carried value. Whether China intended to move in this direction remained uncertain. Official statements said nothing explicit. Central bank communications maintained conventional language about exchange rate management and monetary stability, but the silver kept accumulating, and markets were beginning to notice that accumulation patterns preceded policy announcements by years, not months. The question wasn't whether China had the silver. The question was what came next. Markets operate on two levels simultaneously. The surface level responds to headlines, earnings reports, and central bank statements. Prices move, traders react, commentary flows. The deeper level moves differently. It responds to shifting fundamentals that aren't yet visible in official data. It responds to accumulation patterns that won't show up in news cycles for months or years. It responds to changes in who holds what and why. The silver market was experiencing a deep-level shift. Global silver mine production ran approximately 26,000 metric tons annually. Recycling added another 6,000 tons. This created total annual supply of roughly 32,000 metric tons available to meet industrial, investment, and jewelry demand. For years, this supply had been adequate. Prices fluctuated, but markets cleared. Physical metal moved from refineries to manufacturers without significant friction. Paper contracts on exchanges traded smoothly with occasional delivery without disrupting the system. That equilibrium was destabilizing. If China continued importing silver at the pace observed in late 2024 and early 2025, approximately 10 to 12,000 metric tons annually, it was absorbing more than one-third of global newly refined supply. This left roughly 20,000 tons for the rest of the world's industrial demand, which ran approximately 25,000 tons per year. The arithmetic created an obvious problem. Either industrial users outside China would face shortages, or above-ground inventories would need to fill the gap, or prices would need to rise enough to reduce consumption and increase recycling. All three were beginning to occur. Manufacturing firms in Europe and North America reported longer lead times for silver deliveries. Contracts that previously settled in 4 to 6 weeks were stretching to 8 or 10 weeks. Some suppliers were adding force majeure clauses to new agreements, language that allowed them to cancel deliveries if supply became unavailable. This was not typical behavior in a commodity market with adequate supply. Meanwhile, inventories held in exchange-monitored vaults were declining. The COMEX reported that registered silver stocks, metal available for delivery against futures contracts, had dropped below 100 million ounces. That represented less than 3,000 metric tons. In a market where annual industrial consumption exceeded 25,000 tons, 3,000 tons of readily deliverable inventory provided minimal cushion. The London Bullion Market Association faced similar dynamics. Vault holdings were adequate for normal trading activity, but concentrated Chinese buying had the potential to strain physical availability if it accelerated further. This created vulnerability in the paper market structure. For decades, silver futures and options contracts traded at volumes far exceeding available physical metal. This worked because most contracts settled financially rather than through physical delivery. Traders closed positions before expiration. The system functioned on the assumption that physical demand would remain predictable and manageable. But when a major buyer consistently took physical delivery and removed metal from the system, the assumptions underlying paper trading came under stress. Historical precedents existed. In the early 2000s, nickel markets experienced severe dislocations when Chinese stainless steel producers bought aggressively while London Metal Exchange inventories declined. The resulting squeeze forced the exchange to suspend trading and implement emergency measures. In 2022, the same exchange faced chaos when a major participant couldn't meet margin calls on nickel positions during a price spike driven by Russian supply concerns and Chinese buying. Silver hadn't yet reached crisis levels, but the structural vulnerabilities were similar. If Chinese buying continued at current rates for another 12 to 18 months, and if Western industrial demand remained robust, the gap between available supply and total demand would widen further. At some point, prices would need to adjust significantly upward to ration available supply. Sophisticated investors were beginning to position for this scenario. Hedge funds that specialized in commodity markets increased their long positions in silver futures. Mining company equities began attracting attention from value investors, who recognized that higher silver prices would dramatically improve profit margins. Wealth management firms that served high net worth clients started discussing precious metals allocation in terms not heard since the 2008 financial crisis. The conversation wasn't about speculation or momentum trading. It was about structural supply deficits and the historical behavior of hard assets when fiat currency confidence weakens. Corporate treasury departments faced different calculations. Companies that used silver in manufacturing needed to decide whether to lock in long-term supply contracts at current prices or wait and hope that the market stabilized. Waiting carried the risk of higher future costs. Locking in supply early meant committing capital to inventory. Several electronics manufacturers disclosed in regulatory filings that they had increased raw material inventories beyond normal operating levels. The stated reason was supply chain resilience. The practical effect was securing silver before prices potentially spiked. Financial institutions that operated in precious metals markets faced their own strategic decisions. Banks that facilitated silver trading and storage needed to assess counterparty risks if physical tightness intensified. Clearinghouses needed to evaluate whether margin requirements adequately covered delivery obligations in a market where spot shortages could emerge rapidly. The dynamics extended beyond financial markets into geopolitical calculations. Nations that produced significant silver from mining operations, Mexico, Peru, Chile, Australia, suddenly held assets with enhanced strategic value. If silver transitioned from purely industrial commodity to partial monetary metal, producing countries gained leverage in trade negotiations and diplomatic relationships. Countries heavily dependent on silver imports for industrial production, Japan, South Korea, Germany, faced potential vulnerability if supply access became politicized. This created incentives for quiet diplomacy around resource access that operated outside public view. Trade agreements began, including provisions that previous negotiations had ignored. Guarantees of continued commodity access, commitments to avoid export restrictions, side letters addressing strategic materials. None of this made headlines, but it reflected recognition at senior policy levels that commodity flows were becoming strategic rather than purely commercial. China's position in this evolving landscape was singular. It had secured substantial silver accumulation while prices remained relatively stable. It had diversified supply sources across multiple continents. It had built domestic refining capacity that reduced dependence on foreign processing. And it had done all of this while maintaining plausible deniability about strategic intent. Whether Beijing would ultimately use this position to support currency initiatives, to gain trade leverage, or simply to ensure industrial supply security remained uncertain. But the preparation was complete. Markets would eventually reprice silver to reflect this new reality, not because of manipulation or conspiracy, but because fundamental supply-demand dynamics had shifted while most participants were focused elsewhere. The lesson transcended silver specifically. Monetary systems changed through accumulation long before they changed through announcement. Assets repriced when the composition of holders changed, regardless of stated intentions. Those who recognized these patterns early positioned accordingly. Those who waited for official confirmation learned an expensive lesson about the difference between what markets were doing and what commentary was saying. The data was visible. The interpretation determined everything,